I'm Catherine Thompson, Technology Analyst at Edison, and I'm here today with Tom Cregan, CEO, and Rob Shaw, CFO of EML Payments. Welcome. So kicking off, you reported your first half results today. So Tom, could you talk us through the highlights of the first half from an operational point of view? And in particular, tell us how you cope with the challenges thrown at you by COVID-19 and Brexit.
Yes, well, that was certainly an eventful half. There's no question about that. I think we had the acquisition of PFS that we closed on April the 1st. So we were integrating our largest acquisition to date. We had Brexit, which was really what for those people in the UK and Europe who were working through it, they would understand the kind of level of resource and project management required for that. So that just took up a lot of energy and a lot of focus. But we got that project completed as well. And probably the biggest impact that I think COVID had for us was more in one of our gift segments in the shopping mall space, which stands to reason. We were actually tracking reasonably well on that, up until almost the first part of December. But then obviously most countries went into some form of stage 4 or 5 lockdown from about the 15th onwards. So be that Canada and Belgium, UK, Germany, France, Spain, Italy, Poland, all of those countries that we're in. So that was just a challenge that we had to trade through. We didn't you obviously don't know how those things are going to play out. So we just had to deal with that as it was. Despite that, I think our results in the half were pretty good. I think when the fact that our debit volume was over 10 billion in the half for the first time. So we were 54% up in debit volume, which is clearly an indicator of use of our product and our technology. Revenue was up 61% to 95 million. So again, pretty significant increases there, which flowed through to EBITDA, which is very pleasing. So EBITDA was 28 and change, 28.1, which was 42% up. And our cash flow performance was very strong. So our cash flow performance was north of 100% of EBITDA. So 34.8 million. So as a result of very tight capital management and some flows of breakage and some other revenue flows that came to us. So all things considered, I think a pretty strong half. We had removed our financial guidance last year in May because of COVID largely, and just the uncertainty that provided us with, particularly in that mall space, and how that then flows onto the to the group. And we said we'd reinstitute that once we got through that, and so we've done that as well. So our guidance range for the year. For this year for EBITDA is 50 to 54 million, and analyst consensus is in the kind of 52.5 to 54 million range. So I think all things considered, and the kind of operational challenges and kind of multitasking that we had to do, I think that result was a pretty solid result.
And Rob, from a financial perspective, could you discuss performance both at a group and divisional level?
Yeah, definitely. Thanks, Catherine. In summary, the first 6 months of the FY21 financial year really delivered a strong set of results. It's a record start for us in all key measures. Gross debit volume at 10.2 billion was up 54% from PCP. Revenue 95.3 million was up 61% on the same time last year. And EBITDA at 28.1 million was up 42% on PCP. So some really strong start. These results are pretty close to what we delivered in the full year of FY19. So some strong growth despite the challenging trading conditions, as Tom mentioned a moment ago. If you look at the segments, looking at the GPR segment, we saw growth both from acquisitive and organic sources. PFS contributed $38 million of revenue. We acquired those guys 1st of April 2020, so this was their first full financial reporting period in the group. I'm really pleased with the set of results they delivered. They saw growth across their banking as a service and their government disbursement programs. But then in the non-PFS business, we saw growth from organic sources, contributing $16.5 million of revenue, but they grew 25% on the prior period, which is a really good set of results. And that revenue is driven from both our Australian payroll as a service business programs, as well as global gaming disbursements. So there's a couple of different places. The gift business was obviously had some challenges this year with reduced volumes in the malls in particular due to COVID lockdowns. So we saw mall volumes down about 19%, different markets and different places in that. And it's really impossible to accurately quantify the impact of COVID, and say what you wouldn't do, but it would definitely be more than $100 million of GDV. So certainly impactful to the business. Trading conditions certainly were tougher towards early to mid-December in the run-up to Christmas than we saw in the first part of the 6-month period. But we're forecasting to see an improvement in that business through Q4 of this year, through April to June, and into FY22 as sort of vaccines roll out and lockdowns start to ease. Saw growth in incentives, which is our non-mall portfolio. They're up 11%. So despite consumer programs not really in big full swing yet, because FMCG companies are going to be reluctant to spend material amounts of marketing money when people can't get to the shops to buy their products, we still saw 11% growth, which is a pretty good outcome. And finally, in the van segment, we're pretty flat in terms of volumes over the 6 months. We ended December with a run rate of $815 million of GDV, and that gives us some optimism for FY21. Particularly because we've got quite a strong sales pipeline for that segment. So some good set of results in this 6 months.
And last year's PFS acquisition materially changed the makeup of the group. Could you give us a bit more detail on how this has helped diversify the business and how you plan to diversify further?
Yeah, it's helped a lot. I think in the first half of last year, in the comparative period, the majority of our business was deriving its revenue, 70% or so came from the gift incentive segment. This year, that's down to about a third of the business, just over a third of the business. So the largest segment of our business now is the general purpose reloadable segment. It's our fastest growing business line as well. So it's our largest in terms of gross debit volume, revenue and gross profit, and it's our largest segment. So it really has changed the nature of the group in quite a short period of time. Calling out PFS performed particularly well in most of their key verticals, particularly digital banking and the UK government programs. They're continuing to launch new programs, and we certainly see continued strong growth from PFS into the future. Organically, again, we're pleased to sort of reach 282,000 salary packaging accounts in Australia. We're coming to the end of a transition, but that revenue growth is going to annualize out into future periods. And so that's a strong business line for us. Likewise, the growth I mentioned out of our gaming payout programs will support growth for many years to come. So really some positive growth stories in the GPR segment in particular. We're certainly not, in terms of diversifying further, we're certainly not losing focus on our gift business. We've continued to invest in new technology for that segment to allow our mall partners to sell physical or mobile gift cards, either in-store or online, in a much easier integrated manner. We've spent some money on technology there that's being rolled out at the moment. But yes, we certainly continue to plan for their business to grow into the GPR segment. And building out the business around the reloadable platform that we have, and building out more functionality through our Accelerator project.
And Tom, Rob's just referred to this, the Project Accelerator strategy that you announced last year. Could you give us an update on progress?
Yeah, sure. It's a 3-year project, and it's largely it's largely about driving organic revenue growth, and doing that through product by and large. And when we say product, I mean our product with our customers. So the way that we're interacting with our customers is really our platform. So when Paddy Power is interacting with us, they're interacting with our platform. When the Home Office is interacting with us, they're interacting our platform. So our platform and our technology is how our customers interact with us. And so by having more features and functionality on that platform, we provide a richer experience for those customers, and then we also provide a means of expanding our sales opportunities and our kind of sales horizon. And then the second part of it is really product. So platform on one hand, and then product on the other, that we will integrate into the platform, again, to provide richer experiences for our customers. So by way of example, some of that technology will be built and invested, and we expect to spend somewhere between 10 to 15 million over this financial year and next financial year on that. Some of it will be through what we call FinLabs investments, which are minority investments in technology companies that already possess technology that we need to improve our immediate offering to our customers. And so we're investing in these companies, but they're providing us with technology and a distribution relationship at the same time. So that's by and large, those constituent parts are really are the project, and the end result of that project is all organic growth. So if I put that in kind of practical terms, a customer that comes to us who could be in let's say they're in the earned wage access segment, which is providing employees with the ability to flexibly receive their payroll outside of the traditional payroll period. And these companies are popping up, all over the place in all the regions that we're in. And I think disruption of payroll will actually be a theme we see, over the course of the next, 2 to 3 years. So our customer may be that entity who is providing that to companies. Now, some of those employees may want to draw down on that salary, and they might want to have that drawn down to a card, which would be our existing platform, or they may want it drawn down to a bank account. So our investment in Interchecks in the US, for example, allows that to happen. So it just means that the functionality, is richer for that customer, and therefore we won that deal because of the enhancements in the platform and the product. If we have, when we acquired PFS, 45% of their revenues were digital banks and kind of neobanks. We're working with alternative lenders. We're working with financial wellness companies, where we're looking at taking their technology and integrating that into our platform. So if we're talking to a digital bank or a prospective digital bank, and that digital bank is looking at EML, but they're also looking at 2 competitors, for example, to be the plumbing that runs their business. Other than just providing the financial plumbing, if we're able to say to that organisation, to that prospective customer, do you want the financial plumbing, but do you also want a flexible line of credit solution that we source through a specialist organisation, but it's embedded in our tech? You don't have to do another integration, but what does it mean for you? It means revenue generation. It can mean share of interest margin. It means retention and acquisition for customers. And by and large, that digital bank is going to say yes to that, because they're looking for any feature and functionality that can acquire and retain customers. We then extend that and we say, would your customers have any benefit in financial wellness and budgeting tools? If so, yes, we can bolt that in as well. So it's about that's just another example of kind of adding to the platform and the functionality. We think if we do that, our chances of winning and converting more deals goes up. In the first half, we won 39% of deals in our pipeline, and really we didn't know that number actually until the end of the half, because it's not something we'd actively tracked. But knowing that number and knowing that we're in a pretty competitive global payment space, we think that's a pretty good starting point, given it's our first data point. But if we're winning that as we are today, then Accelerator is about how do you get that 40% to 50%, and so that's what that investment is all about. I don't really see it changing. I think the core of it is the next obviously the 3-year period that we're in. But these strategies will be iterative. I could see us, moving into areas like open banking, for example, that will just form the next kind of component of Accelerator. We're a service provider to companies in financial technology and payments, and we have to. I've said this since almost the day I joined this company, that complacency kills you. You can't afford to take results for granted. We might get 61% revenue growth, but we're in a competitive industry, and if you're not continually investing in product and service and technology, your competitors aren't idle, so they'll be kind of chasing us. So that investment and that growth focus is just something we have to keep top of mind.
And to wrap up, could you talk about the outlook for the company, both for the rest of this financial year, but also in the longer term?
This year, I think there were some core projects to get completed by June 30, which quite a few are Accelerator related. So I think Visa, for example, most of our volume is carried on the MasterCard network. We'll be live certainly in Australia and certainly in the UK and Europe, and the US as well, by the end of September at the latest. Australia is March, the US is probably June, Europe might be August, September. So by then, we are then able to work with customers who are on either scheme. And the reason that is important, I think, is there's volume that we're missing now for sure, because in the arms race of technology, Visa and MasterCard will find, disruptive fintech organizations, and they will make a play for that organization early on to be part of either of their kind of incubator programs. And that means that they can get access to funding, investment, research, and so on. So you're seeing these companies early on deciding that they're working with Visa or MasterCard or Discover or others, and that's part of their core decisioning process. So we've lost out on a couple of opportunities where the prospect, the customer, was aligned to Visa, and we just weren't able to provide the same functionality on the Visa network, which made no sense. So we started that project. It's in full flight. That will be part of our growth, driver alone in FY22 and 23 and beyond, because we'll have access to a whole scheme today that we don't have access to. So that should be a no-brainer for us, to be quite honest, in terms of a growth driver in and of itself. There were some core projects within PFS that were really important to get over the line again by the end of the financial year. One of those being a program with the Home Office, which phase 1 has gone live with, and phase 2 will occur before the end of the financial year. it looks on, that's one. The second key project is kind of becoming a principal member of Faster Payments in the UK. Currently we access that network through another third party. So starting at the end of March and through to the end of June, then we should be fully live on that, which takes about almost 450, 500,000 pounds out of our cost base. Immediately heading into FY22. So again, that was a key project that we've been working on. So there are a couple of, I think, of the core projects that we've got to get over the line. I think in the second half, Accelerator will continue to take shape on more product product enhancements, additional FinLabs investments, because we're continuing to look through a whole list of those. There's several that we have chosen not to invest in because they didn't fit our criteria, but there's always a list that we're kind of working through. So all in all, I think the outlook for the company is just one of activity and growth. I've been completely wrong on the impact that COVID would have on our business. In April and May last year, when there was a lot more uncertainty in the environment, my gut feel would have been that levels of volume of kind of new businesses and levels of customer inquiries and opportunities would be lower in a COVID environment. I couldn't have been more wrong. I think in August we had 305 active opportunities in the pipeline, and we had 408 or thereabouts at the end of December. So we really are seeing a benefit of a big shift to digital payments. Companies really, I know the word accelerator is kind of a bit cliched because it's the name of our strategy, but you're seeing that happen within corporations and governments as well. So I think we're in a sweet spot, of growth. We've positioned ourselves there, but we have to, it doesn't just happen by accident. So we've got to really take advantage of it now that we're there and make sure we fully execute. We continue to kind of redevelop and reposition the company. We were, if you go back in time, if I go back in time to day one, EML was basically a gift card business. 70% of our revenues were related to gift cards. I think as recently as about a year ago. The PFS business has transitioned us to being more of a GPR company, and I think that transition will continue actually in this year with things like open banking and other areas that we intend to enter. So EML will just continue to kind of transition over the course of years to look not like necessarily a prepaid company, but just a payments technology provider to corporates and governments, being able to provide a whole raft of payment solutions to them, whether they're on card or not card, whether they're on payment schemes or through open banking rails. So we never rest. We're always looking at what the outlook is. 2, 3, 4 years out for us is kind of the horizon we tend to look at.
Great, thanks Tom, thanks Rob. Yeah, that's a really strong set of results considering the challenges you have faced in the half year. So thanks again both of you for joining me today.